With the closing of another financial year, we turn our attention to the 2026 financial year, and I'll take you through some of the important changes impacting retirees from July 2025. I'll also cover off some of the proposed government changes that are in the works, and a brief look at what are the superannuation strategies to consider from July 2025. My name is Sean Jones, and I'm a financial planner at About Retirement, and you're watching About Retirement TV. And now, if you're planning retirement or already retired, you've come to the right place. On this channel, we present topics for those who are preparing financially for retirement, or for those who have already retired and looking for education on all matters retirement. Now, I've chosen today's topic to help you look ahead and plan for some of these changes that may impact your retirement strategy. Okay, so firstly, if you're an employee, you can expect your employer superannuation contributions to be raised from 11.5% to 12% of your base earnings. Now, while only this is a relatively small increase, it has gradually increased from 9.5% back in 2021. So what should you do? Well, the start of the year is a good time to review your superannuation to factor in this additional contribution, as well as any salary sacrifice contribution you're making, or from getting a pay rise. Our aim is to measure how you're placed against your total concessional contribution limit of $30,000 for the year ahead. Now, for those who hold their superannuation in an account-based pension or retirement income stream, the minimum pension that you have to pay yourself resets as at your 1 July account balance. Now, the minimum amount you must draw is determined by your age at the start of the financial year and shown in this table. So for example, someone aged 75 will now have to draw 6% of their pension account balance throughout the year. You can of course choose more to draw more than the minimum, and it's a good idea to plan for these changes to your pension cash flow. For those that hold a transition retirement pension accounts, the minimum and maximum amounts that you have to pay yourself remain at 4 and 10%, and the amounts will be determined based on the 1 July balance. Okay, so let's have a look at the transfer balance cap. Now, from 1 July 2025, the general transfer balance cap will rise from $1.9 million to $2 million. So this cap limits the amount that can be transferred from super into the tax-free account-based pension or retirement income stream environment. So what does this mean for those approaching retirement? Well, the increase allows retirees to allocate more funds into the tax-free pension environment. However, if you've already commenced a pension account, you may only receive a proportional increase or none at all. Now, I would strongly recommend that you get specialist financial advice if you have superannuation savings approaching this figure, and you want to check what extra amount that could be added to the tax-free pension environment. From July, there's going to be some significant changes to be implemented in the aged care funding space, impacting residential and stay-at-home care. The new Support at Home program is designed to provide tailored services and home modifications to allow people aged 65 and over to stay at home for longer. However, the cost to move into aged care home will significantly change for new residents from July. The current funding model to cover the cost of care and support services is paid partly by the government and partly by the resident, depending on their financial means and what type of aged care home and services provided. For new entrants from July, the means testing rules shift, resulting in higher costs for the resident with assessable assets above the $500,000 mark and less of the funding provided by the government. But importantly, for those already in care before July 2025, the old assessment rules apply. Now, there is a lot to cover when it comes to aged care funding scenarios, so I haven't gone into any great detail, but we will shortly provide a video that runs through some client examples moving into care. So while it's important to stay up to date with some of these July changes, there are also some proposed changes that we must keep our eye on, and it's important that you know what's around the corner. There's still a wait and hold approach for some significant government updates. Firstly, we'll look at the frozen deeming rates that Centrelink use to determine how a pensioner's income is assessed. So rather than look at the earnings for investments like bank accounts, direct shares, superannuations, Centrelink will apply assumed earnings rates ranging from 0.25 to 2.25%. Now, these are historically low and have been since the economic uncertainty of the COVID period. So these frozen rates have been extended from 2020 and was due to expire 30 June 2025. Now, with 460,000 aged pensioners being impacted by the income test deeming rules, there is some concern that raising the deeming rates will negatively impact aged pensioners with reduced fortnightly payments. And prior to this freezing period, the deeming rates range from 1.75 to 3.25% for the higher threshold. So it's important to stay up to date with these government updates, but there is an industry belief that freezing period will be extended beyond 30 June 2025. Another superannuation proposal that is getting media attention in the wake of the federal election is a proposal for an additional 15% tax of earnings for superannuation balances above $3 million. So this would impact approximately 80,000 Australians. Now, while the measure targets the wealthier retirees, the main opposition to this proposal is the uncertainty for the $3 million threshold being indexed in the years ahead, meaning more people being impacted over time as superannuation balances grow, especially with higher contribution rates. Now, tax legislation has yet to be passed in Parliament, but the drafted timeline was to commence from July 2025. Lastly, I'll take you through what superannuation strategies aren't changing, but resetting. Let's look at catch-up contributions. Now, the annual contribution rates that you can make to super remain the same, but they do reset for a new financial year. So as mentioned before, the annual concessional or before tax contribution limit remains at $30,000, and you have a new year to work with. You should also check to see if you're eligible to carry forward unused concessional contributions from the preceding 5 financial years. This measure essentially allows you to catch up on unused limits, provided that your total superannuation savings were below $500,000 at the preceding 30 June date. So my tip here is to check with your super fund or the ATO portal using your MyGov login for a history of unused contributions over the last 5 years. Next is contribution splitting, which is an interesting strategy. It has been around for a while, but it allows couples to transfer some or all of their concessional contributions made to super from the previous year. So this can be a useful strategy for couples in the pre-retirement years trying to redistribute their superannuation wealth and effectively managing the limits that may apply later in the retirement years, like the superannuation balance cap and the pension transfer balance cap. So I've got an example here to show Karen receiving $28,000 in total concessional contributions in the 24-25 financial year. So from July 2025, the couple could split up to 85%, or in this case $23,800, to Darcy's superannuation as a rollover. The money stays within the superannuation environment, just transferred to the spouse's superannuation account. Importantly though, there are eligibility criteria and you should get financial advice before you're making any decision to split your contributions. Now, if any of these measures or strategies impact you and you'd like to understand how to navigate your retirement journey, you can speak with a financial planner at About Retirement. Feel free to book a meeting by hit the Book a Meeting button and then choose the day and time of the meeting. For the month of June and July, we have opened up our availability to have more meetings with new clients wanting to plan for the new year ahead. So I hope you found some value from this presentation, and please give the video a like and subscribe to our channel, and this is going to be the best way you can support us. And now, please continue watching some of our other videos, with the first recommendation being Katherine's presentation on the government's plan for your retirement savings. And the second recommendation, how much do I need to retire before age 67? Thank you for watching, and I'll see you in my next video.